Hey, this is Ryan Chen here with Locator. In this video, I'm going to show you 7 different ways to get your business out of the red and into profitability. So there are 7 things buried in your financials right now, and they're basically quietly draining your cash flow every single month. And the reason most business owners miss them is because you're boring. They're not growth hacks or marketing strategies. They are pricing, payment terms, receivables, and debt structure. Now, I review hundreds of P&Ls and balance sheets every month at Locator across construction, medical, real estate, trucking, and restaurants. And the same 7 problems show up almost every file from a business that's stuck in the red. 82% of businesses that go under were profitable on paper when they closed. The revenue was there, the cash was not. And when you look at why, it was traced back to the same 7 places. So today I'm going to walk you through all 7 with the actual math behind each one, so you can see exactly which one are hitting your business the hardest and fix them this week. And the 7th one on this list can free up more cash every single month than the other 6 combined. But before we even get to the 7th, let's start with the first one, because this is the one that makes the biggest immediate difference, and that's raising your price. Now, I know that sounds obvious, and I also know most business owners would rather do literally anything else. But the math on this is not even close to anything else on the list. McKinsey ran a study across thousands of companies and found that a 1% price increase, just 1%, generates an 11% increase in operating profit. That is 50% more effective than cutting costs by 1% and 3x more effective than increasing your volume by 1%. Say you are running a business doing $1 million in revenue with 10% net margins. If you raise your prices 10% across the board and nothing else changes, your revenue goes to 1.1 million, your expense stays at 900,000, and your profit just went from 100,000 to 200,000. You literally double your profit without selling a single additional unit. And the data shows that 80 to 90% of businesses that have pricing problems are priced too low, not too high. There is one diagnostic I tell every business owner to look at. If your closing rate is above 80%, you are typically undercharging. That means your prospects are not even hesitating. And even Hormozy said it himself, 99% of businesses needs to raise their prices to grow, not lower them. Now, I see this constantly in loan applications. A business has plenty of revenue, team is busy, sales are moving, and the owner cannot figure out why there's no cash left at the end of the month. 9 times out of 10, margins are too thin because prices have not moved in years, even though costs have. That brings me to number 2, which is something most business owners have never even thought about doing. Fire your worst customers. See, there's a concept in finance called the whale curve, and it shows that in the typical business, the top 20% of customers generate 150 to 180% of the total profit. The middle 60% roughly breaks even, and the bottom 20% actively loses you 50 to 80% of your profits. Let that sink in. Your best clients are making you money, and your worst clients are burning it faster than it comes in. And it always means the same thing. Those same nightmare clients take the most time, pay the slowest, negotiate the hardest, and require the most custom work. So if you have 100 clients and the bottom 20 are costing you $5,000 a year in hidden costs from support time, late payments, and scope creep, that is $100,000 a year in drag that disappears the moment you either reprice them or let them go. You do not even have to cut them all. Sometimes you just raise the prices on the bottom tier to reflect what it actually costs to serve them, and the one who stays become profitable, and the ones who leaves free up your capacity for better clients. Either way, you win. Now, those first 2 are about getting more out of what you already have. But the next point about money you have already earned that is sitting in someone else's bank account right now. Number 3 is collecting your receivable faster. And this is the most boring thing on the entire list, which is exactly why nobody does it well. Right now, US businesses have 3 trillion outstanding invoices on any given day. The average small business owner is on 17,500 unpaid invoices at this very moment. And the part that actually matters is that most businesses offer 28 payment terms, but the actual average collection time is 67 days. That is a 39-day gap where your cash is funding someone else, this operations instead of yours. On top of that, the average company writes off 4% of its account receivables as bad debt every single year. So on 10 million in revenue, that is 400,000 you earn invoice and you will never see. And the fix is not complicated. It all comes down to shortening your payment terms. If you are on net 60, move to net 30. If you are on net 30, you offer a 2% discount for payments within 90 days. That 2% early prepayment discount sounds small, but analyze, it is the equivalent of a 36.5% return on your cash. 65% of vendors will accept that deal, and most businesses never even ask. On top of that, spend 1 or 2 hours to automate your invoices, follow up reminders once, and then just collect free money that most of your competitors will not even realize they are losing. Businesses that automate the AR processes speed up your collection cycle by 60% and save over $34,000 a year, because that's cash you already earned. You're just leaving it in someone else's hand. And if you're already looking at your cash flow and trying to figure out where the gaps are, that is exactly what we help business owners sort out every day at Locator. If you want us to look at your numbers and walk you through your actual options, there's a link in the description where you can fill out an application in about 60 seconds, and our team will get back back to you. Number 4, audit every single recurring charge hitting your bank account. That one sounds small, sounds like nothing, and it might be the easiest money you recover all year. Data from Ramp and Vergis show that companies waste up to 30% on their software spending on subscriptions that are either unused, underused, or completely duplicated. Businesses with 10 to 100 employees spend $60,000 to $110,000 a year on software alone. Nearly half of that provides zero value, and the average company has 7.6 duplicate subscriptions they do not even know about. 7 tools doing the same things, all billing monthly. Businesses that sit down and actually audit every recurring charge recovers $15,000 to $50,000 a year. The exercise takes 1 afternoon, pulls 3 months of bank and credit card statements. Highlight every recurring change. For each one, ask one question. If the subscription disappeared tomorrow, would you buy it again today? If the answer is no, cancel it. If the answer is maybe, downgrade it. If you do it this once a quarter, I guarantee you will find $50,000 to $50,000 a year that goes straight back to the bottom line without changing a single thing about how you operate. Number 5, and this is the one that separates business owners who manage cash flow from the ones who react to it. Renegotiate your vendor and supplier terms. Most business owners accept whatever payment terms their vendors give them and never bring it up again. But if you are on net 30 right now and you move to net 45 or net 60, you just give yourself 2 to 3 weeks of holding your cash before it goes out the door. That alone can be the difference between making payroll comfortably and scrambling every other Friday. And the negotiation is simpler than you think. You call your vendor and you ask if they will consider extending your term in exchange for a volume commitment over the next 12 months. Now, bear in mind that vendors would rather give you better terms and lose a reliable customer, especially if you can offer volume commitments or referrals in return. And if you are on the other side of it and you have cash available, look at the early prepayment discounts your suppliers already offer. The standard 2 out of 10 net 30, which is 2% off for paying within 10 days, gives you a 36.5% annualized return on that cash. 65% of suppliers offer some version of this, and most of your customers never take this. Every day you hold your cash longer or deploy it at a discount is the day your margins improve without even touching your revenue. But here's what I see all the time. Business owners will renegotiate their term, tighten up their invoicing, cut their subscription, and still have no idea if any of it actually moved the needle. Because everything is running through one bank account and the numbers are a mess. Which brings me to number 6. Separate your bank account and actually look at your numbers. I cannot tell you how many loan applications I review where the business owners genuinely does not know their own margins, their labor costs as a percentage of the revenue, or how much cash they actually have on hand. And almost every time, the reason is the same. Everything from personal expense, business expense, other owner draws, and tax payments are through one bank account. That makes your financial statements unreliable, your tax prep a nightmare, and your underwriting a mess if you ever need financing. There's a framework called Profits First by Mike Michaelowicz, and the core idea is simple. Instead of normal formula where your revenue minus expense equals profit, flip it. Revenue minus profit equals expense. You set up separate bank account for operating expense, owner compensation, taxes, and profit, so that every time revenue comes in, you allocate a fixed percentage to each one before you spend anything. Now, the baseline allocation is 5% to profit, 50% to owner comp, 15% to taxes, and 30% to operating expense. And that 30% operating caps force you to run lean because that money simply is not available to overspend. And the biggest thing eating that 30% for most businesses is labor. The total payroll as a percentage of revenue should be under 30% for most industries. If you are above 40%, that's a red flag unless you are in the healthcare or another labor-intensive vertical. Knowing your numbers is boring, but it's also the only way to know if any of the other 6 things on this list are actually working. Now, everything I've told you so far will move the needle, but there's one thing that most business owners are sitting on right now, and it can free up more cash every single month than the first 6 combined. Number 7 is restructuring your debt. And the reason this is the biggest lever is because the math is brutal when you get it wrong. If you're carrying cash advance debt right now, you're paying somewhere between 48% and 350% effective APRs with daily debits hitting your account. Most business owners who come to me do not even know the actual rate they are paying because MCAs are structured with factor rate, not interest rates, and the true cost is hidden. For example, when Juan came to me with his cash advance debt, he used to own a business called YNZ2 in Colorado, Avon, Colorado, formerly known as Nazawa Sushi. He had 4 or 5 cash advances that were drawing daily on his business. We took that money and we refinanced it using a conventional loan with a mortgage against his primary residence, and he was still obligated to pay the $125,000 he owned in cash advance debt. And we basically restructured that $125,000 to a $125,000 conventional note with additional working capital. But that $125K portion freed up $40K of monthly debits that he can now reallocate. We use a mortgage to secure him a monthly payment that's under $6,000. And because of this, he went from $40,000 to $6,000 a month. And that's what I mean when I talk about capital stack engineering. It's not about getting one loan. It's about getting at everything you own and engineering generating the right mix of products. A business HELOC starts at 8% here. A 30-year DSCR loan starts at 6% there. A term loan in the middle. Layer them so your total monthly debt service drops and your cash flow opens up. Right now, 12% of borrowers have negative cash flow and 13% have interest coverage below 1-to-1. Chapter 11 bankruptcies hit a decade-long high last year. And in almost every case, the businesses that went under were not bad businesses. They were businesses with wrong debt structures, paying too much every month to capital. That should have been cheaper and longer. That is the most boring fix on the entire list. And that's the one that moves the most money. And that's exactly what we do at Loancator. We look at your full financial picture, your cash flow, your existing debt, your assets, and we engineer the capital stack that actually makes sense for where your business is right now. We have funded over 1,000 loans. We work with 50+ institutional lending partners, and we carry a 60% approval rate across our application base. So if you want us to look at your situation and tell you exactly what your options are, there's a link in the description below where you can fill out an application. It takes about 60 seconds and our team will walk you through everything. I'll see you guys on the next one.